Welcome to the Zions Bank Economic Update. My name is Joseph Mayans, and joining me is Robert Spendlove to discuss the current economic conditions and provide an outlook for 2019. Robert, for most of 2018, the economy seemed to be doing very well. Employment growth doing pretty good. We have low unemployment, 49-year low at 3.7%. Stock market did pretty good up to about the middle half of the year, but really now we've kind of seen a turn in sentiment where markets are a little more uneasy. The Fed's future rate path may be in jeopardy. What's kind of going on here?
Yeah, we're in a really interesting period in the economy right now. Just like you said, our fundamental economic indicators are still looking really good. When you look at the last jobs report, we had 155,000 jobs created. The unemployment rate stayed at the level of 3.7%. Wage growth came in again at 3.1%. So it was a good report. When you look at GDP, the broadest measure of the economy, it grew 3.5%. We even just got new figures for inflation, and they're also within kind of the bounds that we would hope to see. So the fundamentals are looking good, but we're starting to see a little bit of storm clouds on the horizon. So when you jump over to the Fed, the Federal Reserve Bank sets interest rates, and the Fed had been saying that they were going to raise rates 4 times in 2018, and then 3 times in 2019, and potentially 2 more times in 2020. But we've started to see the Fed kind of backing off from that a little bit, and there's some question about whether they're going to follow through with those rate increases.
Right. And so I know there's been a lot of talk on the street of, a looming slowdown, a possible recession in the future. What are some of the indicators that you're tracking, or some of these other metrics that people are looking at that may indicate that?
Yeah, it's always scary when you hear the R word. Recessions tend to invoke, feelings of uncertainty and fear. But it's really important for us to kind of be honest about what we're seeing and some of the indicators that we're seeing. And one of the surest examples of this is something we call the yield curve. And it's a really technical term for something that's really important. But if you kind of just break it down at an individual level, a bond is essentially a loan. And what kind of loans do people get? Well, you might get a 30-year home loan, you might get a 15-year home loan, or you might get a 5-year car loan. So if you get a 30-year, if everything else is equal, if you get a 30-year home loan, the interest rate will be higher than a 15-year home loan. And that 15-year home loan will have a higher interest rate than the 5-year car loan. So you can kind of see, if you were to graph those interest rates, it has an upward sloping curve on that yield. So the yield curve is traditionally upward sloping. As the time frame of the loan extends, it slopes up. However, from time to time, the yield curve will actually invert, or it will go negative. And that's kind of a signal of, essentially an early signal that a recession is coming. Right. Last week, the yield curve inverted. And so it hasn't fully inverted, but the difference between the 5-year bond and the 2-year bond has now inverted. So you actually get a lower interest rate on a 5-year bond than on a 2-year bond. That doesn't make any sense. Why would someone pay less for something that's riskier? But the reason for that is the Federal Reserve Bank controls, or has more control over, short-term interest rates, while longer-term interest rates or longer-term bonds are controlled more by the market and by people's investors' expectations of future economic activity. So what we see is the Fed kind of pushing up the short term, but because investors are more concerned about the prospects of the future economy, it's pushed down those longer terms and has now inverted the yield curve. Right.
So with some of this, investor uncertainty, what is driving this? What is happening in the economy that is making them feel this way and inverting the yield curve?
Yeah, so great point. I just described the what, but there's still the question of the why. One of the biggest things that is driving this apprehension or this fear is the impending trade war. We continue to see escalations. We continue to see saber rattling. Recently, the Canadian government arrested the chief financial officer of Huawei, which is one of the largest telecom companies headquartered in China. And America is asking for that executive to be brought into or extradited into America for prosecution. What we can see is now there are escalations in this. There are also America and China have not been able to come to terms on a trade deal. Now, we do hear kind of back and forth. So on a good day, when we hear good news, you'll see the markets go up. Or on a bad day where we hear bad news, markets can drop dramatically. 1 week recently, the Dow Jones Industrial dropped over 1,100 points. But when you've got this combination of trade fears, and then we're seeing around the world, international markets are showing increased weakness. We're seeing, for instance, job growth in China has actually dipped negative for the first time in many years. And so we're seeing kind of these signs all around. And as investors are watching this, they're getting more and more concerned about the ability for us for the U.S. economy to continue its strong growth path.
Right. So we're coming to the end of 2018 now. I know a lot of people are interested in the outlook for 2019. How do you see some of these trends that you've spoken to a little bit here? How do you see those developing in 2019? And is there anything that you're really keeping an eye on?
Well, if we go back to the fundamentals, what does the Fed focus on? They focus on two things, full employment, and they focus on low and stable inflation. Where is our unemployment? We're at 3.7%. That is below the full employment level. So I think we will continue to see, at least in the first part of 2019, a further tightening of labor market conditions. It's going to be harder and harder to find more employees. We could see that unemployment rate drop even further. Could drop down to 3.6, 3.5, even as low as 3.2%. As those labor market conditions continue to tighten, we're going to see that driving up wages because it's harder to find workers. As those wages, so that 3.1% that we talked about could go up to 3.5 or 4%. And now that increase in wages is great for workers, but it's really tough for employers. And so what they're going to have to do is raise prices to pay those higher worker salaries, which will cause inflation to go up higher. So I expect inflation to rise higher, could go as high as 2.5 to 3%. And then the Fed will be in a really tough position where when we've got an inverted yield curve, but the Fed's seeing increasing inflation, they are going to have a real struggle whether they continue their rate-raising path or whether they start to pull off. However, most market observers believe that the Fed will not follow through with a full 3 rate hikes, going up essentially 75 basis points in the federal funds market. Maybe 1 or 2 if the conditions stay strong, but if we start to see deterioration in our economic conditions, then we'll start to see the Fed pulling back.
Yeah, and I think a lot of it will have to do with what happens with China if that continues on.
Absolutely.
Thank you, Robert. Thank you for joining us for this economic update. For more information and analysis, please visit zionsbank.com/economy.